Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Thursday. It's November 16th. It's about 7:48 in the morning. The market's going to gear up and open up about an hour and 42 minutes. If my math serves me right, it's still a little too early here. Before I begin or before I get into all of this, please make sure to join my VIP room. It's happening at 11 a.m. today. I'll answer questions live. It doesn't cost you anything. For the time being, I am going to be closing it up. I'm just not sure when. But get into it. The link is below this video on the YouTube channel. Also, if you haven't done so, subscribe to my free Telegram channel. Just go to rogerscott.com/Telegram, rogerscott.com/Telegram, and you'll have access to my Telegram channel where I give free tips and tricks all day long. And I post those videos there as soon as they're out, and you get pictures of my assistants, Clyde and Bonnie and Clyde. All right, let's get into the market today. Wow, what a few days it's been. All right, so the Nasdaq right now is down about 49 points. The Dow's down 94 points. One of the reasons why it is down is because earnings. As I mentioned before, Walmart came out with their numbers. And just to show you what Walmart is doing right now, Walmart is down about 7%. Look at that. Didn't do well. That's going to impact on retailers today. And unfortunately, what is it? I think we're long a couple of, well, anyways, I'll get into all of that in a bit. But we're long Dollar General. That may have a negative impact on Dollar General today, but I'll show you where my stop loss is just so you could see right here. It's right below this level right here. So we got plenty of room to the downside, but we may get some impactful market action on Dollar General and retailer stocks. But it's not all negative, and let me show you what I'm talking about. Macy's came out with earnings, and the stock is up substantially. Also, Applied Material, I think, is coming out with earnings later today. But as you could see right here, you've got Baba, you've got Walmart, you've got Bed Bath & Body Works, you've got Bezer Homes, you've got Gap, you've got Macy's. So there's a lot, Ross Store. A lot of these stocks are coming out. Let's see if Ross Store is out already. You could usually see by the big move. No, not yet. Probably afternoon. So it's going to be a very, very tumultuous day today and a very volatile day without a lot of directional bias. Now, speaking of bias, the bond market. The bond market closed yesterday right in this channel. As I mentioned yesterday, if we break out of this channel, the bond market is now pricing in a zero chance of the Fed raising rates in January or December. I think that's a little premature. I think the Fed may raise rates in January, and I think or maybe a little bit further down the road. But the fact that they're done, I don't think that's in the cards just yet. But the bond market, this is the long bond. It tracks the 20-plus year bond. So if you see this breaking up to the upside, that means there's a very strong sentiment that interest rates are going down, which is really good for retailers, really good for shopping, really good for our economy. And if you see it breaking down right here, that's a very, very negative sign. And that tells us that that interest rates are, in fact, going to go more likely than not higher. But this is a really good gauge of sentiment. And right now we have this ascending triangle. And I'm hoping that it's going to break out to the upside. So we do have a lot less movement against the stocks that we like to buy and own. And the economy will move further ahead. But we need to break above this level. One of the biggest reasons why the stock market had a rally, actually not one of the biggest, the reason why the stock market had a rally like this and is holding on like this, like it did the other day, is because the CPI data and the PPI data last few days is telling us, not PPI, PPI wasn't that great, but the CPI data is telling us really very, very strongly that things are getting better. Now, so we may have some volatility today, but look at this. I mean, my God, look at this price action. And again, one of the reasons why day trading hasn't been as great because of these gaps. These gaps, they steal all the intraday trading action that would have led here. So when you see a gap like this, the market basically has to catch up, and that's why we are swing trading. We're currently actually short LTMH, which is down pretty good right now. And we're long Dollar General, which is down a lot this morning. And we're also long, not Costco. What was the other stock we were long? We're long Shopify. Sorry, they're retail stocks. And Shopify is more of a tech stock. But again, there's a lot of these gaps. They don't really do us any favors. They snap market action and cause the market action to occur overnight. And I talked about that yesterday in my Telegram channel. So looking at the S&P, as I mentioned, we're down, but this is really random. This isn't anything crazy. 78 points, 45 points on the Nasdaq. This isn't such a big deal, and we can definitely bounce back, and we do have some longs and shorts. Now, speaking of global economy, let's just talk about what's on deck, and then I'll talk about technicals and price levels. But I wanted you to have a little idea of what's going on in the market in terms of our positions. So blue chips posted a 2.5-month high. Nasdaq posted a 3.75-month high. Target surged 17%. So things were not looking so bad. But again, today, Walmart really screwed the pooch. Economic data on Wednesday, Producers Price Index came weaker than expected. Core PPI came weaker than expected. But the CPI came in a lot better than expected. Barkin stated Wednesday that he remains unconvinced that inflation is heading towards the central bank's 2% target despite acknowledging real progress. I agree with what he's saying 100% in curbing price pressure. I'm just not convinced that inflation is on some smooth glide path down to 2%. That's where I'm at right now. Finally, Fed is not BSing us as much as they did beginning of the year. That was just awful. Things are getting better. I mean, what do you... don't get me started. Earnings, as I mentioned, Walmart, Applied Materials, CPRT, Ross Store. So Walmart has not given us any favors, but we still have these others to look forward to today. And we have the Philadelphia Manufacturing Index, and we have industrial production. Now, industrial production happens right before the market opens, and that's a pretty big report. I wish they were all at 8:30, but I guess they have to spread them out. Nonetheless, it still happens before the market opens. In terms of, do we even have jobless claims? Yeah, jobless claims right here. Now, I know it's a big report, but I'm telling you right now, unless this number goes to like 250, 270, nothing's going to happen. It's been fairly consistent. It's been actually holding up really well, and I don't think it's going to be a big topic of discussion. So initial job, that's what I was talking about right here. Europe down just a hair as regarding potential dovish pivot for central bank diminishes while investors focused on Eurozone inflation scheduled for release tomorrow. Utility stocks outperformed everything. That's defensive. China closed lower. They're having a huge issue with their real estate sector. That's where their problems lie. Japan closed lower again. They snapped a 3-day winning streak as investors decided to lock in profit following a significant rally. A lot of what we're seeing right now is, I hate to say the word profit taking because just as many people take profit, take a loss, right? But you know what I'm talking about. Neutralizing their position after this rally. Cisco plunged over 10%. Palo Alto plunged more than 5%. AAP fell over 2%. Plug fell over 3%. Stone gained more than 1%. That's pre-market. Again, the big movers today are going to be right here. Walmart, Applied Materials, Copart, and Ross Store. Gap is also reporting, and it'll be very interesting to see how they do. Now, looking at the QQQ, which we will look at right now, you could see that it's very close to the top. Now, the question is, when is this gap going to get filled? And I'm pretty sure this gap is going to get filled. The question is when. Momentum has been very strong lately. I mean, it's been really strong lately. But again, if we start breaking below this level right here on the QQQ, which is 382.79, we could see some downside selling pressure. So be very careful. Keep your eye on the bond market. Looking at the small caps, keep your eye on the bond. If this rallies, it gives us some relief. If this goes down, it causes stress. Looking at small caps, which we'll look at right now, you could see that they look like they've pivoted right here, and they look like they're going to start coming down, which is good for our position LTHM because that's in the Russell 2000, and it looks exactly like the Russell 2000. Take a look at it. Right? Looks just like the Russell 2000 with this pivot. Actually, it looks worse than Russell 2000. But the point is, I think we're going to start cooling off on the Russell 2000. Small caps they've seen a lot of upside, but they haven't really seen a big reason outside of a couple of earnings reports that are better. So be careful, and I would expect this gap to get filled first. So be really cautious up there. Now let's take a look at sectors and see what's really happening. So if we look at each individual sector, Let's organize it by strength. 6 weeks, technology, home builders, utilities, real estate, retail, QQQ, energy, consumer discretionary. I don't think it can be more mixed up than this. I mean, this is mixed up. 3 weeks, yeah. Home builders, semiconductors, real estate. Well, we got some common themes here. We got consumer discretionary, technology, home builders, chips. So here we know that real estate, interest rates may be going down. So real estate and home builders are sparking up. You also have small caps. That's a sign that Fed may be done. You got retail. So speculative stocks in the last 3 weeks have been gaining, and blue chips have been lagging all across the board. These are all smaller stocks. These are all speculative stocks. These are all hyper interest rate sensitive stocks in terms of in terms of a bull market. Home builders, real estate, technology, consumer discretionary, QQQ, small caps, retail, and mid caps. So this is pretty clear. It's pretty clear in the last 3 weeks. The speculative, the ones that are the first to rise when interest rates go down, are the ones rising. Okay, in the last 5 days, let's take a look. All right, well, it's been about the same. Speculative, 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 speculative. So it still looks to me like communication, consumer discretionary, and here's all the blue chips, including the S&P 500 and financials. Weird that QQQ's over here, but consumer discretionary and technology are up here, and semiconductors are up here. But again, everything is screwed up right now. But we can clearly see from this that speculative sectors that are more involved in technology, interest rate sensitive sectors are in fact been leading, and we obviously know why. Now, we're going to stay with that trend because that trend seems to be working. But let's look at the charts to see if we can get a better idea. Home builders, not so sure. Retailers, look at retailers. Look at the Russell. Quite honestly, nothing is looking that great right now. Technology is looking pretty good. Consumer discretionary is looking pretty good. QQQ is looking pretty good. Communication services is actually looking really good. The Dow Jones is starting to look good, but we got this area right here. I would be very, very, very cautious. Matter of fact, honestly, I'll tell you, I like the communication sector the best right now. It's holding on to those gains. So let's look at XLC. XLC. Yeah, that's a strong buy right now. Look at that. So look, we're above all the price levels. We're breaking up here. We're still near here at this level. I like communication services. And remember, we still have that end of year pesky bullish seasonality. That means markets typically go up during this time of year. And I like communication. I'm going to give you a call, but I'm not going to give you a short dated call. I'm going to give you a call that expires in, let's see, 29 days. That's pretty good. That'll give you a little time. And they're not expensive either. Look at this. You can get the 60. The liquidity will open up once the market opens. You can get the 68 for about $2.60, or even the 69, which is a little bit in the money, which doesn't have a lot of implied volatility. You could do that for less than $2. But that's what you want. You want 29 days out. You want 69, roughly the 69 or 68 strike price. That would be the way to go. Now, again, we're going to have a lot of volatility today. You've got a lot of earnings. Give the market some time to decide what it wants to do. I'm a little more bearish than bullish right now. I'm about 60% bearish than bullish just because we've gone up so much, but we got to go with the trend. So I'll be extra careful today. And also remember, we have 3 positions that we're nursing. We're nursing Shopify. And I like Shopify. I think Shopify is going to continue moving higher. We're nursing, what else are we nursing? Dollar General. Got a nice little uptrend here. I know it kind of did this yesterday, but as long as it can stay above this level and not negate the downtrend, we're still bullish. And we're short LT. I got the wrong ticker symbol, sorry. LTMH. Hard to remember these tickers. And we're short this stock, and I'm going to stay short for a little while because this pivot was lower than this pivot, and it looks like we're going to break down again. Again, before I let you go, Celeste Lindman. Did you guys know that Celeste Lindman, she's a CPA, and she's the best at finding ways to squeeze every dollar possible out of the market. which is super handy skill to have considering all the economic headwinds we've endured over the last year. Rising interest rates. Have you seen the mortgage costs lately? Ay, 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 vey. Ugh. Inflation at a 40-year high. I'm looking at the graph right now. Global conflict, supply chain disruptions, inconsistent Fed, earnings being all over the place. Don't get me started. Don't get me started. And it couldn't be simpler to figure out what Celeste is up to because she's put together an ultimate dividend portfolio for regular folks like you. Yes, to help you make additional income each and every week. It couldn't be simpler if you know what stocks to target. Join her at 1 p.m. Eastern Time today to learn 3 simple steps to building an income-producing portfolio and get her top dividend stocks right now. Click the link below and supercharge your nest egg today. I'll see you guys later. Make sure to send me emails at roger@rogerscott.com, and I will see you soon, and hopefully the market starts to cooperate with us. Bye, guys. Have a great day.